Hey, what's happening, guys? Hope you're doing well. Today, I'm going to spend some time with you explaining how interest rates work. This is probably equally as important for me as it is for you. And the reason is because most of the time when I get that first phone call, it's, hey, I'm interested in buying a house. What's your interest rate? Whoa, hold on a minute. You'll a lot of times, if you've ever asked that question to a lender, you'll get met with a little bit of resistance. Sometimes the lender's going, tell me more about your scenario. I would probably ask, are you going to move into the property? Are you going to rent it? Is it a second home? How much money down? You know what your credit score is? Any idea how much income you make? So I can kind of calculate your DTI. I mean, there's a variety of different things that will impact the interest rate that you're going to receive based on your application, the data that's on your application. So it's not a one size fits all. I just pull down on the 30-year fixed bucket, look at it and go, oh, interest rate 6.5% today. It doesn't work like that. It's going to be a little different for each and every person because each and every person has a slightly different application profile. So I want to spend a few minutes kind of explaining not only where we derive those rates from, but also what makes them tick. How do you search for them on your side? Because I think sometimes that can be a little bit confusing. How do you protect yourself if you're in the middle of trying to shop for a house? Like, what are the things that you can kind of get caught with? So let's dive deep into this. I'll try to keep it as quick as possible, but I don't want to rush it because there's a lot to go over. So we're going to start first and foremost with our friend Google. If you were to jump on to Google and ask Google, what is today's interest rate? You would get something like this. In fact, this is from today. Today is July 18th. I'm recording this live. And according to today with Google, interest rate is 6.99. Now, does that mean that you're going to get 6.99? Absolutely not. You might get a better interest rate. You might get a worse interest rate because the program that you're getting, your credit score, what you're doing with the house, how much down payment, a variety of different factors are going to impact this. But Google's basically saying, hey, we're going to make an assumption based off of a $300,000 loan from the data that we can see online, 20% down payment, California property, 780 to 799 credit score. You're going to be right around 6.99. You can kind of play around. If you ever do this on Google, you can mess around with a lot of these. You can even impact or input another program or something else to compare on there. And I would just say, do this as just a ballpark of where things are at. If you're kind of in the early phases of shopping, you kind of want a general idea. You don't want to run your credit. You're afraid to call a lender. You can just kind of simply run this and get a ballpark. It's not going to be perfect, and it's not going to be the interest rate you're going to end up with for your house, but it'll at least give you enough context so you can simply run some numbers. You can find a good loan calculator. We have a great one on our website, but you can kind of play around with it and have a pretty good idea where things kind of stand there. Another place you can go, which is probably a little bit more accurate in some ways, is Optimal Blue. Now, what this one is, this is actually a website that we use in the industry to go in and kind of plug in all the data points from your loan application to price it, compare all the different lenders, different places that we fund loans through, and see who's offering what. So as an example, I might plug in 20% down payment, conventional loan, a certain price point, certain FICO score, debt ratio, all these various things, and it's going to spit out 20 or 30 different 30-year fixed loans, and I'm going to sift through them and see, okay, based off of just that data, knowing what I know about each individual program, which one kind of fits you best. You'll see in the next slide, there's a wide variety there's a wide difference actually between 30-year fixed loans, and they're all using the same data to come up with that. Sometimes the guidelines from one program to the other one are going to be either more restrictive or less restrictive and so on. And there's going to be some pricing variables as a result. So why I point this one out, this is actually taking, so this example here, the 6.742, it's taking the average of rates that this system sees. Remember, this is an industry professional. This is a loan officer or a mortgage company that uses this tool to price the loan and to lock in the interest rate. It's just simply saying, hey, based off what we see, a conforming loan or a conventional loan, 6.742 is the average right now. Now, it doesn't take into consideration how much down payment, credit scores, the purpose, whether it be a purchase, a cash out refi, a rate and term refinance, let's say it's going to be an investment property or second home or an owner occupied. All those things are going to have different impacts on it. The place where maybe we're locking the loan with 2.5 points. We lock in that loan with 2.5 points. Maybe we catch it on a day where that rate's a little bit lower. Well, that's going to feed into the averages for this. And it doesn't show us anywhere how many points are included in this. It just shows the average rate that they're seeing in real time that's getting locked through their system. So this one's kind of cool because it's kind of showing you, hey, if in real time right now, people that are locking loans, they're getting around 6.742 on average. Some loans have 5% equity or 5% down payments on these loans. Some of them have 90% equity on them, and they price out incredibly aggressive. The point is, this is another place that you can kind of look, and it gives you just a general feel for how things are kind of stacking up. I'm going to give you like a little bit of a peek behind the scene here in this next slide. So this one right here is kind of what it looks like when we plug it in behind the scenes. So we're going to plug in the loan amount, we're going to plug in the sales price, the value of the property, if there's a second mortgage on it, what the credit score is going to be, debt to income ratio is going to be, what the purpose is. Again, if it's a purchase, if it's a refinance, is it a primary residence, a second home, an investment property, where's it located? There's a variety of different things you can see here, even down here, single family residence or a condo, how many units are in it, is it a duplex, triplex, quad, how many stories, 1 or 2 stories, is it a attached condo, a detached condo, you name it, manufactured home. All of these things kind of play into factor to give us the results on what the loans are. And it's kind of taking that, it's starting to filter down this really wide field of 30-year fixed loans into something a little bit more manageable. But even then, if I use the criteria that we have right here, you'll see it on the next slide, there's a long list of 30-year fixed loans that kind of fit this particular profile. And so that's where our job comes in, to kind of take what's available to us, make sure you fit the guidelines for that specific loan, and place you in the best one humanly possible. I'll share that with you right here. So if we take a look here, you're going to see in this scenario, 7%. So remember a couple slides ago, Google said 6.99 was kind of the average that they're seeing right now. Well, it's not too far off. This particular scenario was 7%. And over here, what you can see where this discount is, or it has a -0, this has to do with the cost. So when you hear from a lender, or if you've ever heard the terms of buying a rate down or paying points on a loan, this is where the points would show up. They would show up right in here. So on my side, if I was to price this loan for somebody, I could honestly tell them, hey, that rate would be about 7% today. And it would be 7% without a buy down. No, they're not paying any points. You're not buying it down, and you're not getting a credit for it. 7% would get you there. Now, what if you needed to save a little bit of money on your closing cost? You wanted to actually get a lender credit. Well, you could actually go a little bit higher in the interest rate. In this scenario, 7.250, so a quarter higher in rate, would give this person $875 credit from the lender to pay for some of the other closing costs. You could use that to apply it toward your appraisal, or maybe your escrow or title fee, something like that, right? So it's going to lower that down. The other thing I wanted to point out on this huge screenshot, this isn't all the investors, by the way, it's just a quick snapshot of them. Look all the way over here. So this is the same exact scenario. You've got rates that are in the 8s. And not only are they in the 8s, so 8.125 right in here, it also over here has a whole point. So this one, 8.125, had a 1 point cost, meaning you had to actually spend an extra point to get that loan because of whatever they're associating with the risk on that loan. It's a little bit more expensive. So we were basing this off of a $140,000 loan. So in this scenario, an extra $1,400 in closing costs to get that loan, and that loan's at 8.125%. Now, you have to have a lot of options. As a lender, it's really important for us to have a ton of options, because if I only had a handful of these right here, I'd only be able to offer the client who called in and kind of fit that profile an 8% mortgage. But in this scenario, assuming that everything kind of fit guideline-wise, I could actually offer that person a 7% mortgage. Big difference, in this scenario, it's only $140,000 loans. The payment difference isn't that much, but it's still, it's really close to, a little over $100. You got $931 for principal and interest. You got $1,040. We'd save a little bit of money by doing that. It's important to have a lot of options at our disposal for that. Now, with all of these, when we price out a loan, you can always buy the interest rate down. So I want to show you a couple examples on that. So using that same example, if we go back, 7% mortgage, what if we want to go down a little bit? We want to get it just a little bit more aggressive. Maybe the seller's given us a closing cost credit and we want to use it to get a better interest rate. We can. 6.75 in that same scenario would cost a half a point, would be about $700. However, what if you don't fit that particular loan? What if you fit this one down here? Well, that same 6.75% interest rate is available. You can get it. So I could almost guarantee the client, I can get you 6.75. I just don't know what the cost is going to be. It's going to be determined by how well that application fits the guidelines for each particular provider, each particular loan product. So that program to get to 675 could be as much or as little as $700 to buy it down and get it, or it could be as much as $1,700. Varies a little bit case by case. Let's look at another one real quick. What about 6 1/4? So now we were at 7, 6.75. You could tell it didn't move the needle a lot on the payment. What about 6 1/4? I think that would make a big difference. Well, instead of that, you get that payment down a little bit. Now you're at 862. If we go back a couple of slides, we were looking at originally at 931 in that example. So we get 931 down to 862. It moved it a little bit, but it cost us $2,600, maybe as much as 36, just again, depending on where the loan kind of fits. That would be a decision we would have to discuss and make sure it actually fits. Well, what if we want to get more aggressive? What if we don't want to have that? We don't want the patience we hear all the time, interest rates are going to get a little bit better in the next couple of years, refinance later. If we just don't want to deal with any of that, we want to be one and done. Let's just buy the rate down to 5%. So I use this as an example just to kind of show you can. In this scenario, 5% is available, but it would cost $10,000. And it would only bring that payment down to 752. So again, in the 9s down to 752, does it really make sense for a couple $100 to spend 10 grand out of pocket? Probably not. Every scenario is a little bit different. You can actually see even on some lenders, they're going to price out. These are really small snapshots. There's probably 30 different loan options on this, but you can tell I use this one just so you can kind of see a ballpark on cost. You can also see the NA, meaning it's not even available. They just don't want to even offer it right now. The cost is a little bit too high to get to that price point. There's probably the reason the cost gets really high. These loans get sold into secondary market through coupons. There probably isn't a lot of bidding activity, meaning like Wall Street's not buying that at a high level. And so there's just not a lot of appetite for it. So the cost is really high. So wherever these loans are being delivered to, probably like, hey, they don't want those coupons right now. We just don't have a good bucket to put those loans in. One thing that we talk about a lot as a lenders, we talk about the fact that interest rates move around literally on a daily basis, and it can be a little bit daunting as a consumer going, well, how do I make a decision? There's a certain price point or certain monthly payment I'm trying to hit. I got to go out and shop for a house. I can't go get one like in 30 minutes. It's going to take me a little while to find the right place, get my offer accepted, etc. How do I know that my rate is going to be protected? We kind of don't. There are some programs where you can lock in the interest rate and then go shop for your house, but there's some disadvantages to that as well. We could actually have a complete sidebar on how that strategy works. But the point is, most of the time, we're going to wait as a lender to lock in the loan when we know you're in escrow on a particular property and you have a specific amount of time. So maybe it's a 30-day escrow to buy your house, and we know the timeline that we need to guarantee the rate for and protect it for. We're going to lock for that period of time to make sure that carries all the way through for your closing, so we don't have to pay an extension fee or anything to kind of extend it out further. So what I wanted to kind of show you is some things that kind of happen, some risk that you need to be aware of when you're shopping for a house. So let's say that somebody here in the beginning of February was out looking for homes. They called in and, I don't know what the rate was exactly at that specific day, but let's just say that rate was 6%. And now we're in the middle of March. You can see what happened here. So interest rates, if you see these number or these little pegs right here, they call it a Japanese candlestick. If these are improving a little bit, this is better interest rates. As they decline, the value of that particular bond is getting worse. This is a higher interest rate. So anything down here, higher interest rates, anything up here, better interest rates. So somebody here, let's just say 6% was what they were estimating all of their payments and everything off of, but it took them a month and a half to get into escrow and try to, finally get their property to a place where they could go and lock in. Well, now all of a sudden they might have moved from 6 to maybe they're at 7 1/4 in that small period of time because the market's kind of, it just kept moving over time. You have to be aware of that. So a lot of times when we do a pre-approval, we are padding that interest rate specifically because these events happen. This is really kind of an extreme example. You can see how far it moved in a very short period of time. If you kind of look here, I mean, literally every day they're kind of pinging up and down, but generally they're trading within a tighter range. There's another example where they kind of had like a little bit more of a violent move right here. This would have been kind of middle of May, and then through June they just kept getting clobbered, getting worse and worse and worse. And we just actually ran through that. So the end of June, all the way through beginning of July, rates got worse, and then they started to pick up. Look, we got all these little green bars and this activity here starting to have interest rates improve a little bit. And look, in the future, we do expect these to continue that trend and eventually get to a place, hopefully way up here. So we have much better interest rates. Maybe something that starts with a 5 or even a 4 for that matter would be really well received in the real estate market. But right now, this is kind of what things are doing. And so when we're locking a loan, we're pricing it to give you an expectation on things, but we're also trying to be really diligent on when we lock and why. So one thing that you want to kind of pay attention to. So let's look at this one, May 11th, right? Right here is May 11th. And, the pricing that day, 101. And if I go to the next screen, we're looking down here, May 26th. So May 11th, we didn't lock. Let's just say we waited. We thought rates were going to get better and they didn't get better. May 26th rolls around. So that pricing was at 101. Now it's at 99. To keep it really, really simple, if we go all the way back to that screen that showed the discount points of the buy down fee for that, if a client was trying to get a rate here, a specific rate, let's just use 7% as an example. They were trying to get 7%. And that day, that the pricing in that bond was right around 101. Well, then by the time they decided, I've had enough, I just need to lock and protect my loan, and they still want 7, there's 2 points. So we're 101 down to 99. There's 2 points movement during that window of time. So that rate that didn't have any points associated with it at 7 could potentially be still available to them, but it would cost them 2 points to get that same loan. It just has to do with the way that the market had shifted during that period of time. And I kind of point that out to you because when we lock, we have to fully understand, is it a good time to lock? Is it a bad time to lock? You're not going to know on your side. There's really no way that most people aren't going to know how to watch that and monitor it. We keep it up on our screen. We listen to reports on it. We kind of see the trending. We know when to protect. And we use things like this, the candlestick that we've been just looking at. We might look at some trending, like in this scenario, we might see right here, hey, we've got a little bit of resistance right here, but we have some support. Our trading range, our window is only this much. We're not really at risk of losing too much. Let's see how the next day goes. If we can close maybe here, we got a little bit of room to kind of grow before we hit some more resistance. But tomorrow, guess what? If it opens and starts to tank and it gets below that, we want to lock that loan right away so we can avoid a situation like this. Right? So if we kind of looked over here, this one, it broke beneath that. This would have been a great point for me to jump in. If I was protecting your loan, I would have locked that loan, said, hey, I know you think it might be getting better because a couple of days prior it was getting better the days before, but right now we need to protect it. It's going to get worse. And guess what? Once you break that resistance line, it's just a free fall. So those are things that we start to look at kind of on our side. All right, guys, hopefully you find that helpful. I just want to give you a little bit of context on how that stuff works. Any questions that you have, any specific scenarios that you ever run into, let us know. If I can express 1 or 2 things to you, I think when you're asking a lender about interest rate, you're kind of shopping one lender to the next just on interest rate alone. That's the only thing you're asking them. You can tell, going back a few slides, it moves around a lot. Let's go here. You could call a lender here and you could call a lender here, and the person you talk to here that gave you the quote right here, you're going to think is a terrible lender because this guy gave you a much better quote. The reality is the market settled in right here. So if you're not getting them literally at the same exact time, you're not locking that loan in that moment, you're not getting something accurate. And what a lot of people do, it's a little bit of a dirty secret in our industry. What a lot of people do is they will lead with this price that they've recently seen, and they'll give it to you right here. And it's not the right way to do business, but it happens a lot of times. They'll tell you, oh, the interest rate's going to be here, and they're using a former reference point that they had, hoping that by the time you go out and find a house, they can lock you when it comes back. It's really dangerous on your end, because if they don't give you the right number, you go into escrow on something, you're expecting a certain amount of closing costs, you're expecting a certain rate, so your payment lands where you need it to land, and you don't get that. What's going to happen is you're either going to have a higher monthly payment because they're going to counter you with an interest rate that's much higher, or your closing costs are going to be significantly higher than what you're expecting. So unfortunately, that's what happens in our industry sometimes. Just be careful of the advice that you get. Look at loan estimates when you see them, and hopefully the lender is really transparent on how many points there is. But the reality is, if you send out a loan estimate and somebody's not in escrow or anything, and you misquote that number, not locking anything in, the consumer actually doesn't know, unfortunately, until it's locked. They don't know that the number that they're really going to get is going to be a lot worse. So you got to be really careful with that. Just make sure, again, there's a clear understanding on your end and with your lender that there's a lot of transparency around how things are going to kind of shake out and what to expect. Also, in this market, I would highly encourage you to make sure that the lender is qualifying you with a little bit of room in your interest rate. Don't use the most aggressive interest rate that's out there. Use one that's slightly padded, because if the rate moves and you find the perfect house, you got to have a little bit of wiggle room. Otherwise, you're going to go get a call that says you don't qualify for that perfect house anymore, or you need a cosigner. You got to pay off, 5 different debts to qualify. So those are some of the challenges that you can run into at some point. All right, guys, hopefully you find this helpful. Let me know if you have any questions. Leave a comment below. I'm happy to answer those. I kind of dive into some one-off comments that are sent to us every once in a while, and we'll talk to you in the next one. Thanks, guys.